Hey everyone, welcome back. If you're deep in your LSCPA review, you know that inventory auditing can be a nightmare. It's a total puzzle, right? So today, we're going to crack the code on one of the toughest parts, making the numbers on the books actually match what's sitting on the shelves. Let's jump right in. Okay, so let's get right to the heart of it. This is the mystery that drives every single accounting student crazy. You've got your perpetual record, which is like this perfect real-time log of everything, in theory. And then you do the physical count at year end, and surprise, the numbers just don't match. Why? Why does this happen basically every single time? All right, here's how we're going to tackle this. Think of yourself as an auditor detective. First, we'll look at the inventory puzzle itself. Then, we'll find our two biggest clues: who actually owns the stuff and when things happened. After that, we'll use those clues to crack a real case, and I'll leave you with the ultimate cheat sheet for your review. Sound good? Okay, section 1, the inventory puzzle. Right, so this is the core of the problem, right? Your client's books say they have X amount of inventory, but when you go and physically count it, it's a completely different number. That difference, that gap, that's where our investigation begins. And that's your mission should you choose to accept it. You, as the auditor, have to hunt down and explain every single peso of that unlocated difference. It means digging deep into transactions, finding what was missed or what was messed up, and then making the adjustments to get the books to reflect reality. All right, let's grab our first clue, our first major tool for this investigation. It all comes down to one golden rule: ownership. Seriously, tattoo this on your brain. If you own it, you count it. It doesn't matter where it is physically. Is it in another country, on a boat? Doesn't matter. What matters is who holds the legal title at year end. Okay, let's talk about a classic exam trap, something the LECPA loves to throw at you: goods on consignment. This is basically when one company, the owner or consignor, parks their stuff at another company's store, the seller or consignee, to sell it for them. The million-peso question is, whose inventory is it while it's just sitting there on the shelf? And the rule is actually super simple. The consignor, the original owner, always includes these goods in their inventory. The consignee, the one selling it, never does. Why? Because ownership never actually changed hands. The consignee is just a middleman, an agent. The goods still belong to the consignor until a real customer buys them. Okay, let's put this into practice. Here's a super typical mini case you'd see on an exam. A company has 70,000 pesos worth of its goods sitting in another store on consignment. But when they did their own inventory count, they forgot to include it. So what do you think? Is that right? Should they have left it out? No way. Based on our ownership rule, the company, the consignor, still owns those goods. So that's 70,000 pesos. You absolutely have to add it back to their inventory. That is a classic must-know adjustment. All right, clue number 2. This one is all about timing. We're talking about cutoff errors, which are super common. And to master these, you have to understand FOB shipping terms. FOB, or free on board, basically tells you the exact moment ownership of goods jumps from the seller to the buyer. And there are two main flavors here. First, FOB shipping point. Think of this like hitting send on an email. The second it leaves the seller's warehouse and gets on that truck, bam, it belongs to the buyer. The buyer owns it while it's in transit. Then there's FOB destination. Here, the seller owns the goods the entire time they're traveling. Ownership only transfers when the truck pulls up to the buyer's doorstep. See the difference? Okay, let's look at another classic problem. This one's from the Bird Company case. Picture this. It's December 29th. A vendor ships 279,000 pesos worth of goods to our company. The terms are FOB shipping point. Now, on December 31st, at the stroke of midnight, those goods are still on a truck somewhere on the highway. So, the big question is, does Bird Company include this in its inventory for the year? Pause for a sec and think about it. Who owns the goods on the truck? Since the terms were FOB shipping point, ownership transferred the moment it left the seller on the 29th. So yes, Bird Company owns it. They have to add that $279,000 to their inventory, even though it's not physically there to count. Okay, let's do this. Time to put our two big clues, ownership and timing, to work. We're going to crack the full Bird Company case now. Let's take what we've learned and solve this thing. So here's how we break it down step by step. We start with the number from the physical count, 3,740,000. Now we adjust. First, add that $279,000 for the goods in transit, because we know Bird co-owns them. Next, there's $81,000 in work in process that's at a contractor's workshop. Still Bird's property, so we add it back. Then, some customers returned goods worth $147,000. That's back in our inventory, so add it in. And finally, don't forget freight in. That's a cost of inventory, so we add that $48,000. And after all that detective work, we do the math and we get our corrected balance, 4,295,000 pesos. That is the real number that needs to go on the statement of financial position. Case cracked. Okay, pay attention to this. This is a pro tip for the exam. An inventory adjustment is never lonely. It almost always has a friend. Remember that $279,000 for the goods in transit? We added it to inventory, right? But we haven't paid for it yet, so you also have to increase accounts payable. It's a double entry. Forgetting the other side of the transaction is a super common mistake. These things have a ripple effect. All right, get your phones ready because you're going to want to screenshot this next part. This is your ultimate cheat sheet, your high-speed LEPA review. We're going to do a rapid-fire rundown of all the key rules. This is the study hack you've been waiting for. Let's lock this in. FOB shipping point, it belongs to the buyer the second it's shipped, so you add it to the buyer's inventory and their accounts payable. FOB destination, it belongs to the seller until it arrives, so the buyer does nothing until they get it. And here's the best hack. If you're ever confused, just ask, if the truck crashes, who's going to be crying? Whoever takes the loss is the owner. Next up, those special ownership situations. Goods on consignment always belong to the consignor, the owner. Work in process at a contractor? Still yours. Don't forget it. And what about goods you've already packed up for a customer? Don't exclude them from your inventory until the ownership has actually transferred. You gotta check the FOB terms to know for sure. And finally, let's talk about common traps designed to trick you. Unrecorded purchases. If the goods have arrived at your warehouse, you better have the purchase and the AP on the books. Period. Customer returns. If they bring it back before year-end, you have to add it back to inventory and reverse the sale. And this is a big one. Undelivered checks. Just writing a check doesn't do anything. Until you physically mail it, you can't reduce your cash or your accounts payable. Don't fall for that one. And really, this quote just says it all, doesn't it? The entire goal of what we're doing is to make sure everything the client owns is on the list and everything they don't own is off the list. It's that simple and that complex. And look, mastering this isn't just about scoring points on the LACPA. This is the real deal. Getting inventory right is absolutely critical for financial statements to mean anything. It messes with assets, cost of sales, net income, basically the whole picture. It's all about making sure that people who read these reports can actually trust them. So I want to leave you with this final thought. When you're an auditor and you find a company with tons of these cutoff errors, what does that really tell you? It's more than just a math problem, right? It's a huge red flag. It's a clue that there might be something seriously wrong with their internal controls, their processes, or maybe even their management. It's your job to figure that out.